Good afternoon, and thank you everybody for joining us today for our webinar titled The Full Conversation Journey. We're going to talk today about how to leverage equity and compensation strategies to build a successful people strategy for your company. My name is Andreas Goeldi. I'm a partner at b2venture. We are a European venture capital firm investing in early stage startups all across Europe. Before I became a VC, I was an entrepreneur myself for 20 years in both Europe and the United States. So I got to experience compensation questions from all kinds of different perspectives and therefore know, of course, how important this topic is. We all know that hiring and retaining the best people is an absolutely essential factor for the startup of for the success of any company. And of course, great people are attracted by a whole range of factors: your company's vision, culture, quality of the team, what kind of role it is, growth challenges and growth opportunities, and so on. But obviously, compensation is a big part of the mix of any hiring and retention discussion. And that's what we are going to focus on today. We also shouldn't forget that any startup, any tech company is still nowadays in a very competitive hiring environment. You're not only competing against similar companies in your geography, but increasingly globally in today's time of remote work, and of course also against large corporations who often can pay much larger compensation packages than maybe startups can afford. So compensation is, in other words, one of the trickiest challenges of startup and generally company leadership. And we as VCs get a lot of questions all the time from portfolio companies about, I want to hire a new executive, what's a competitive package, and how do I structure the equity component, and so on. So it's an everyday challenge, and we're going to drill into this. I'm really thrilled that we have two of the best experts in Europe about these topics today with us as speakers. We have Vaso Parisinou, who is the Chief People Officer at Ravio, and we have Yoko Spirig, the co-founder and CEO at Ledgy. They will introduce themselves in a minute. Before that, I want to mention that we are going to talk for about half an hour here about various aspects, and then we'll open the virtual floor for questions from the audience. You will find a chat function and in the sidebar in the tool here, and please use that to submit your questions that we can then answer later on. So let's kick it off, and maybe let's start with Vaso. Welcome again to this webinar, and please tell us a little bit more about yourself and what Ravio is doing.
Yes, cool. Thrilled to do so. Hi, everyone. Great to be here and great to be sharing the stage with Andreas and Yoko. I'm Vaso. I am the Chief People Officer here at Ravio. Ravio aims to take the pain out of compensation by providing real live market insights to people leaders, finance leaders, any leader, any manager, anyone who deals with people. We're really excited to be dealing with this very painful problem, and hope with a bunch of new features that are coming out that we're one step closer to solving the pain that comp brings to all of us.
Thank you. And Yoko, over to you.
Yes, likewise, really glad to be here. Hello, everyone. Looking forward to the conversation ahead with you, Vaso and Andreas. So I'm one of the founders and CEO of Ledgy. And in a nutshell, what we do at Ledgy is the following. So when a startup hires a team, they typically give equity to those team members. And over the life of a company, this often ends up being, hundreds or even thousands of people who co-own the company. And that comes with obviously a lot of complexity, especially in Europe, where companies hire internationally very early on. So the complexity is very, very quickly there. And so we at Ledgy, we help by automating everything around giving equity to your team, including all compliance topics as well, and really make it transparent to the employees as well, thanks to dashboard. And yeah, really excited for the conversation that's ahead today around compensation strategies.
Thank you. That's great. So let's kick it off with some more specific topics. So maybe starting with Vaso. So we often hear that companies want to pay competitive compensation packages, right? And that's kind of the term that you hear most frequently. And it's always a bit hard to wrap your head around what does that really mean, right? And in practice, you often hear that, oh, founders are going to ask a few of their buddies what they're paying their COO, and then that's what they think is competitive. I guess there must be a more systematic approach. So maybe tell us a little bit how you do this with more sophistication and a systematic approach, figure out what competitive means.
Yeah, sure. I mean, let me start by saying that it is really, really hard to think about compensation and to break it down systematically, as you say, Andreas. One thing that I've coached founders that I worked with in the past, and one thing that we focus very systematically on here at Ravio is, when we think about paying people competitively to what, right? Are we comparing ourselves with, similar sectors, similar industries, similar headcount, similar funds raised? What is it that we want to be competitive against? Usually what I found to be the most sort of sustainable and logical, proxy is the companies that we are competing with for talent, right? So I want to pay competitively relative to the companies that I'm hiring from, I want to hire from, the companies that we compete with for recruiting purposes. And within that, so once you have the clarity of what you want to compare yourself against, then I think discussing or deciding as a leadership team or together with a founding team, whatever makeup works best for every company, deciding what percentile makes sense for your particular company to target themselves against. Now, some companies may decide that it makes perfect sense to target the same percentile across all teams in their company and across all markets. Others may decide that, hey, you know what? Our tech teams, the strength of our tech team, for example, is of disproportionate impact to the end result of this company. And therefore, I want to bet big on this particular team. So I'm going for 90th percentile, 95th percentile on the tech team. And actually, I'm okay with being less competitive on, say, the commercial side. Ultimately, the makeup of the business will determine that. But the most important thing is for people teams together with their leadership team, founders, finance, whoever it is that we're partnering with, to have the clarity and the thesis around their compensation strategy to make sure that they can communicate it adequately to their employee base, and also be proud and have the conviction that, hey, here's our comp philosophy. Here's why we think it's competitive. And any questions, welcome to answer them.
I think that's an excellent point, especially, and maybe let's stick with the aspect of communication for a second. So how do you communicate this internally, especially when you have kind of, let's say, this idea of, oh, we pay our engineers on the top of the market and maybe the marketing department not so much? How do you communicate that internally, but also towards candidates when candidates figure out, oh, that's maybe not the best compensation package I could find in the market? How do you explain that?
Yeah, totally. Great question. Look, philosophically, I believe in full transparency and in being very open with our candidates, our employees. People are adults, right? So if you give them all the information that they need to make a decision based on whether they join or whether they stay at a company, then I find that really empowering, both as a candidate and an employee and a people leader. I love that. I want to know what I am paid and why, and then I can decide whether that philosophy works for me or it doesn't. And so I will always default to as transparent as possible on the comp philosophy, as long as you've got to be clear. You've got to have conviction in your in your thesis, and you've got to be able to look candidates and employees in the eye and say, hey, here's what we think, here's how, here it is documented, and hope you like it, and if you don't, then it's not a good fit right now. And I think that's the way forward, and it's certainly a value that I live by.
That's great, thank you. Maybe Yoko, let's switch to you and to the topic of equity. So the idea that employees get equity is in Europe still relatively new, and you already mentioned it in the intro. It's still complicated. It's different in every country and so on. So we sometimes hear founders say, oh, I'm not really sure I should do that because it dilutes my shares and it's so much work and so on. But obviously, increasingly, we see that it's standard in the market. So maybe talk a little bit about why do companies introduce equity plans? What's the main benefits that they get out of it? And also maybe what are some of the top challenges that they face?
Absolutely. So maybe one of the easiest ways I can think of, the why behind equity. Maybe first of all, before I go into that, it's also really backed by data. So many studies show over multiple years that employee-owned companies grow faster and overall perform better than those that are where it's not the case. Our own studies also consistently show over time that employees, the majority, so over 80% of employees report that this contributes to their motivation. So it's also all backed by data. But ultimately, really, the why behind giving equity is for me the way that's most striking is actually by sharing a quick story, and that is if you take, for example, the example of a sales team, right? Sales is often very well known to have as a metric, commission-based comp. So very, in that sense, cash-driven. That being said, I was talking with one of our trusted advisors who was to be a SVP of sales at Slack and Dropbox, and he asked me the question, well, what is actually success for your sales team? How do you actually measure success for your sales team? And well, people might say, well, MRR or revenue, that's how you measure it. But actually the true success, even for a sales team, is the long-term success of the company, right? And how do you actually reflect this fact into comp, where the answer is equity? Because on top of cash, which is more short-term, the equity is really what actually incentivize that overall company performance for the long term. So it's really that long term, that overall component of your compensation, which is key for the company as a whole, and to really work as one team.
Yes, I think that's an excellent effect of equity. But I mean, obviously, in early stage startups, especially, we are talking about really long term, right? Sometimes it takes 7-8 years or more from when a person joins to an exit. So how do you calibrate that for people when they are maybe a little bit more short-term oriented sometimes?
So do you ask in terms of how do you calibrate that in terms of how much to offer, or what exactly do you
Yeah, a little bit of both. I think it has a category of explaining it, right? It's a complicated topic and many people don't necessarily understand it, rightfully so. On the other hand, also how do you retain people over time, right? With maybe additional option grants and such.
Yes, absolutely. So I think what is key is, and that actually touches on a point of one of the main differences that we still have today in the European ecosystem compared to the US, is the understanding by employees of what equity is. So it's super important when giving equity to employees to actually take the time to explain. And we see a lot of our customers have the biggest success, or the best practice we can share from our experience with our customers as well, and with ourselves as well, is to do batch sessions. So really with all new joiners once a month. It can be super short, super straightforward, but simply doing it, simply having a deck, and in fact even having the CEO or one of the founders jumping in and explain, what's actually the long-term vision, what's the ambition for the valuation of the company as well. That really goes a really long way and makes sure that you're offering a lot of value to your team by offering equity. So it's really important to actually make that clear and explain that to the employees. So that's one. And on the second part on how much to give, well, there are benchmarking software such as Ravio, among others. And I think also I would love to hear Vaso's view on that. But for our philosophy there as well is to be as transparent as possible. So having a clear grid and really a formula-based system on how much you get depending on which role you take in the company.
Totally agree with everything you've said, Yoko. But one thing that I think ties in really well with what we mentioned earlier around transparency and empowering employees and candidates alike with all the information they need to make a decision. One thing that we found works very well is to talk about and model out very honestly potential scenarios regarding future exits. So if you're seeing a 5x, 10x, 100x multiplier, this is what it will look like for you. Pre-tax, obviously, but this is what it might look like for you. By the way, of course, it might all come to zero, and that's by definition, the possibilities are against us in the startup world. So it might be zero, but it might also see this kind of increase. And one thing that we talk about a lot is, certainly someone who chooses to join a Ravio or another very, very early stage company, there the risk is asymmetrical, right? So you may be choosing to join a tiny company, and there's some risks associated with that. But also the potential, if you happen to hit a potential unicorn in the making, then actually that upside is absolutely life-changing. And for some people, that's so empowering that, they want to join this ride, and it might end up being life-changing, or it might end up being zero. And equally, other people are like, hey, you know what? This isn't for me. I want to have like the steadiness. I want to know what I'm going to be earning in 5 years, and I don't really want to gamble on the future. Either way, having that information enables candidates to make the right decision for themselves at that point in their lives, because it might be different things at different times. But we found that, talking about the success stories that we've had at our company through various folks who have joined, that's been really great for candidates. And it's both worked out in that they've said, that sounds exciting. I hope Ravio is the next one of that. I'm going to join. Or equally, that's pretty terrifying. Actually, I'm going to stay where I am. And that's cool too.
Yeah, it's great. We keep coming back to this aspect of transparency. And maybe a little bit related to that question for Yoko. So we already talked about Europe being complicated, right? And you hear horror stories occasionally. There was one well-known unicorn where people ended up with 6-figure tax bills for more or less worthless stocks, stuff like that. So what should companies do in the most important European countries, and how should they structure these option plans ideally, and who can help them doing that?
Yeah. So, at the end of the day, what matters most, I'll share, let's say, the how companies do it, and then I think what are best practices in our experience. So mainly what companies do is, they start in one country, and typically they have a plan, an employee participation plan, an equity compensation scheme for that country. And then, nowadays they would use an employer of record, such as remote.com, DL, or those ones, for instance, to hire new people in a new country. And then the stage 3 is if companies decide, well, I'm going to open, let's say, an entity in France. And then typically they then go from offering equity from their first entity, let's say a Swiss entity, to then really offering equity from that new entity, which is then tax optimized. So that's really the main difference, that when you offer your equity from your mother entity, it tends to not be tax optimized for the employee in the specific region. And when you really open up an entity and open up a country-specific scheme, then it's tax optimized. And so the main way companies go about it is really in this way, so iteratively, which I think is a good way fundamentally to go about it. I think there again, the main thing is to say that transparently. So to say, look, you're going to get equity from that entity. And for now, we won't open an entity where you are today, but that might change the future or not. So really just explain how it's going to look like. So that's on the tax and internationalization front. And then I think in terms of more, the question of how do you actually structure, how do you design your scheme? I think at our stage right now in Europe, I think what we've seen among customers that people sometimes tend to complicate their schemes, in fact. And I think in a startup, what is more important than figuring out what exact design and complex design to do in your plan, it's actually rather to keep it rather simple. So time-based vesting, typically for companies, for growth stage companies. And because in startups, things change super fast. So it's also not that easy to tie it to exact performance that something should be reached or not, and so on, which is more relevant than for public companies and way later stage companies. So in a nutshell, I think the main advice we can give from our experience is to really keep things simple in a fast-growing early stage company, but then really offer it to everyone, because the level of complexity is going to increase by giving it to the whole team. So better to actually keep things simple at the beginning, and then as the company matures and then goes public, for instance, then really introduce those more performance-tied mechanisms for vesting.
Yes, I think that's great advice to keep it simple. I want to remind our viewers that you can ask questions in the chat function. So we'll have time at the end of the webinar to answer your questions that you might have. I want to maybe stay a little bit with this aspect of complexity, especially in an international context. So Vaso, I mean, many companies nowadays obviously have remote staff, right? We have portfolio companies who have developers in Nigeria and Ethiopia and so on, all over the place. And there's a big discussion all the time, of course, how do you pay people in these very different geographies, very different income levels? Does everybody get the same? Do you change that by geography and so on? So that's one aspect. And the other aspect is, of course, that in any given company, you also have departments that have typically different compensation structures, right? So sales, for instance, tends to have more of a variable pay, commission-based and so on, other parts of the company, not so much. So how do you deal with these kinds of aspects? And what's especially also your recommendation regarding remote work pay levels?
Oh, yeah. I mean, it's super, super complex, and I wish I had the answer, but I don't. I can talk about, some of the difficulties that we've sort of thought through and the strategies that we recommend. But yeah, across our portfolio of clients, we see a few different models. Ultimately, I'm not encouraging one model in particular, but I am encouraging the clarity and having the discussion with the leadership team, founding team, whoever it is, early doors, so that you can nail down your compensation strategy, be very clear about it, and then execute on it ruthlessly according to where you're hiring, etc. Ultimately, you need to have that. You need to have the comp philosophy first before you, so that you're consistent when you start hiring across different markets. So across our client portfolio, we see one group of customers that pay people the same, regardless of where they are based. So typically, those salaries will be according to the HQ of the company. So, for example, they'll say we're London-based, Barcelona-based, Portugal-based, and we are paying. Here's what we're paying for these roles. Wherever you're hired, that's what that's what we are prepared to pay. And that's it. There's no negotiation. There's no, there's no change of the rules. This is it. That's the one model. The second model we see is where we see a tiered approach. So, for example, if you live in a very expensive city, something like London, Paris, New York, that's a tier 1 salary. A tier 2 salary will be something like regional UK, regional France, regional Italy, something like that. And then tier 3 will be something like markets where the cost of living is way cheaper, something like a Greece or a Cyprus, something like that. So this tiered approach to salaries. And then the third approach that we see, and this is actually quite complex to administer, is where folks are paid equally post all tax benefits, etc. So it would be something like, I want my software engineers to be netting 3,000 euros per month, say. So what do I have to pay in Poland, in Greece, in Cyprus, in England, in order for them to see that net in their account at the end of the month? Now, that does get difficult to administer at scale, but takes into account the most complex benefits, tax, etc., that make a huge difference sometimes according to the market that you're based. Either way, there's always fun stuff to play with, whether that's benefits. And at Ravio, we provide an amazing benchmark of what other companies are offering for benefits. Of course, there's also equity that you can flex according to the markets that you're in. So all in all, you're able to pull a lot of levers to create a compelling compensation framework. But you can't do it if you're not clear on what you're offering.
That's great. We have now talked, and both of you have brought up this point of, do it systematically, have a clear grid, clear layers, and so on. But how do you handle exceptions? So I invest quite a bit in the AI sector, and currently, of course, that's going crazy. And sometimes you have these discussions of, we have this candidate who's coming out of OpenAI or DeepMind or something like that, absolute superstar, doesn't really fit in our pay scheme. How do you deal with that, and how do you communicate that, if at all?
Yeah, really great question, Andreas. And I have to say, the amount of times I've been asked to make an exception based on the most amazing candidate. I've never met. There are so many candidates who have been the best candidate, my hiring managers have ever met, So, we need to sort of rein in what it actually means to be an exceptional candidate. So I think, having a framework around what does it mean that this person is, absolutely exceptional, and if we don't hire them, there will be, existential risk to the company. Like you need to nail that down. Otherwise, every single person is the best candidate ever. So I think nail that down. And then again, just be clear and have a clear framework about what you do regarding exceptions. So it might be that you say, for the top percentile of candidates in these particular fields that will move the needle for this company at this point of time, we will make an exception within a framework of, plus minus 10, 20%, whatever you agree with, and then communicate that. As long as you're able to look people in the eye and say, hey, here's our philosophy for exceptions, I think that's cool. And equally, if the philosophy is we make no exceptions, that's cool too. But the company needs to be aligned.
Yeah, that's great advice. Maybe to talk a little bit about the current general market situation. I think this is a question for both of you. I mean, as we are all aware, we are now in the second year of a downturn in the startup ecosystem, right? And we have seen a lot of fairly dramatic headlines about layoffs and all of that. And of course, I imagine this also affects compensation quite heavily at the end of the day. I mean, you're hearing about down rounds and so on, and that's typically something that affects equity plans as well. So maybe from both of you, maybe starting with Yoko, what do you see currently going on in the market, and how can companies deal with these kinds of setbacks from an equity compensation perspective, especially?
Yes. So I would say two things. Number one, you just mentioned down rounds and repricing, possibly stock options and so on. Obviously a very sensitive topic because it's also not just up to management team. It really involves the board, investors, and so on, because it ties really to the valuation of the company. And I would say here, it really depends on the company, because every company has a different, growth journey, a different confidence in actually growing into their valuation. I think probably one common pattern might be that it depends on the stage. So the later you are, the closer you are to your exit, to your IPO, the more pressure you have to actually really take measures, because it's kind of clear to everyone that, well, if we're gonna have an exit next or in the next 2 years, it's very unrealistic to reach the valuation that we currently have. So that's why we see really a lot of late stage companies who take measures, take action. And then in the early stages, it's more nuanced, because you just have usually more time to grow into those valuations, again, depending on your case by case. So that's one. And the second part I will say is we see also a lot of people, a lot of companies want to conserve cash, extend their runway in this environment, legitimately so. And there, a lot of companies actually look at equity it should never be an excuse to not compensate people well, right? Like we all want to compensate people well, offer fair salaries, but equity can actually really be used there to actually entice people, give them that convincing argument to join the company without having to cash out a lot of cash, which is a very precious resource in these times.
Maybe Vaso, from the general compensation point of view, what are you seeing currently?
Yeah, definitely. Look, it's been a really challenging and interesting time for people leaders, for comp leaders. Starting with COVID, we saw like at the beginning, a very aggressive downturn from one day to the next, where salaries took a tumble. We had redundancies across the board. Then it was followed by, I would say, one of the most aggressive job markets of our generation. Wild salaries, wild hiring. We couldn't hire recruiters. They were gold dust. At that point in time, and now followed again by an aggressive downturn, where sadly we've been seeing redundancies at scale, and probably a bit of a correction on tech salaries across the board. Interestingly, what our data is showing is that the correction in terms of tech salaries hasn't been so aggressive. So salaries are still at a very respectable level. But we're not seeing the sort of crazy spikes month on month that we would have seen at the post-COVID job market. So it feels like it's leveling out slowly. That said, of course, the relative value of option packets will have, in some cases, fallen dramatically. But again, I think, that's part of the game. And as long as we've been upfront at this point that, it might go up and it might go down as well. That's a reality that we have to accept.
Yeah, no doubt. I mean, what I'm hearing is quite a bit that companies now feel a little bit challenged about how to retain their best talent, especially in these more difficult times, right? Because suddenly the job over there at the big bank looks much better than 2 years ago. And one phenomenon that I've experienced sometimes in my career as an entrepreneur is as well that, suddenly one of your key employees approaches you, tells you, oh, you know what, I'm quitting, I got a much better offer, and I really feel unfairly treated because you never increased my compensation significantly. Sometimes in my experience, the best employees are the lousiest salary negotiators, right? And that seems to happen quite a bit. So how do you deal with the aspect of proactive retention, especially when people might not be feeling comfortable asking for a lot more money, especially when times are not so easy, right? So do you offer pay increase proactively as a company, or is it really up to negotiation? Maybe both on a general compensation and equity perspective, maybe starting with Vaso.
Yeah, of course. And look, this is something that I'm very, very clear on. There are some employees that they're the stars, right? They're the rock stars, and if they leave, there is existential risk to the company. Don't let it get to that point. These are your your pirates, your gang that will help you get to the next level, right? And for me, being bullish with the people that you know are absolute rock stars and are performing for you is absolutely integral to the success of the business. So it can be scary, sort of feeling that someone's already really engaged and you're sort of proactively giving them a nice bump. But also, I think having both been on the receiving end of that, but also seen the impact it has on employees on both sides, it can be so rewarding to get a surprise proactive, hey, you've done a great job, here's a spot bonus or whatever it might be. That's really it's really empowering to have that recognition, I think. So my overall advice is for the people that these are the people that are gonna stay with us and who I want to stay with us. It's good to be bullish, I think, on comp. That's my personal philosophy.
And Yoko, same question for you. I mean, you often hear, oh, now especially in difficult times, let's give the superstars some top-up option packages. So what's your opinion on that, and how do you do this best?
Yes, I think for me the main thought here is, in a fast-growing company, in a startups, there are like a million things to do, and so maybe thinking about compensation, especially those kind of maybe refreshers and so on, it might be not top of mind because you have like thousands of fires burning in parallel. And I think what comes to mind here is just to be consistent about it. So really have regular review cycles built in, and that just allows to be just very inclusive, because that allows to not just have conversation with people who will be loud and raise their hand and maybe complain or so, but really proactively have that conversation built in, also with people who maybe will ask less. So I think that just works really well to just review that and have those review cycles built in your year.
Excellent, thank you. So we have some viewer questions come in. So Svenja asks, what are best practices for salary bands rather than paying the exact same salary for the same role to account for differences in performance? And how large should the band be? How often do you adjust people's salaries as they climb the career ladder? So Vaso, do you want to take this one?
Oh God, there was a lot in that. There was a lot in that question, and happy to follow up afterwards. Please add me on LinkedIn. More than happy to really go deep on this question because there's a lot in it. But yeah, salary bands are really important. It's a feature that I think we launched just last week here at Ravio, and I'm so proud to have worked on it. It's really important that you're aligned on how you think about the band. So are there, for example, within the band 3 stages related to, for example, task maturity or performance? yeah, how wide or how narrow you want them to be is also really important to decide as a comp philosophy. Typically, you would see, I'm not a fan of super wide bands. I think they're really confusing. So having, I guess sharper, narrower bands, especially while you're at the beginning of the career, makes it easier to see what the upward trajectory is. But yeah, salary bands are so difficult to roll out, and typically, they involve a Frankenstein Google sheet of different data sources, and it's a nightmare. That's something that we've tried to solve, and I've worked very, very closely with the product team to roll that out. And we have a bunch of best practice content and advice that I'm more than happy to share. But yeah, I can talk about this for 2 hours, so I won't. But anyone who'd like to geek out on this with me, happy to catch up later.
Yeah, it is a complicated topic. I think we have all been there. So question from Jörg. We have been talking a lot about numbers here. Thank you for that. But what's your take on non-monetary motivation to win and re-win talents? Maybe good question for Yoko. I know that Ledgy has a very strong culture, right? I mean, full disclosure, we are an investor in Ledgy, a very happy investor. So I know the company well, and I'm always impressed by the culture. So what do you do at Ledgy on non-monetary terms to win and retain talent?
Yeah, so I'm unsure here if it's meant like if equity is considered monetary here in that sense or not, but definitely if not, equity definitely is as said, I think at the beginning, it's really the part that if cash is more the short term day-to-day incentive, equity is really there for the long term to really retain people. It comes with also simply time-based vesting, among others. And so, but more on the, I guess, if I understand the question, more on like the maybe cultural and non-monetary motivation. I think in general, it's just to I don't have the, to be honest, I don't have the right answer. The one thing that comes to mind in my personal experience is to ensure to really stay close to the key people, a bit like what Vaso was mentioning before, to really ensure that that who are really those people who are the key people within the company, how to actually stay close to them. And that's just not just leadership team, right? It's like really within the company, stay connected and make sure to not just be in your bubble of your maybe leadership team, but really go beyond, do those one-on-ones, connect with people to really ensure that you actually know what's going on beyond just your day-to-day interaction. So yeah, in a nutshell, I would say stay connected, do those skip levels, and ensure that people really speak out their mind to you.
Yeah, I completely agree with that. Sorry to butt in, but just to give a massive thumbs up to staying close to your folks. I think it's so important to, these are our customers, our employees, right? What is it that you would like to see in terms of benefits? And again, it's different things at different times of one's life, but there's no harm in asking and then seeing how the company can use its sort of buying prowess to see whether they can broker a great agreement for I can't think of anything right now, but something that is important. Interesting things that we've seen come up through the Ravio benefits benchmarking things, or things like amazing benefits like fertility help for fertility payments, which is extremely expensive, I think pretty much worldwide. Other random things like paternity leave. So if you get a pet, you're allowed, I don't know, X days off to help it acclimatize. There's a whole bunch of things that are really interesting to see, are important to people. And I think it's great knowing what else is out there and what other companies are offering to see, how and whether they would be appropriate for for your folks. And equally, it might be that you find that your folks are like, hey, you know what, I just want cash. And it's great to know that,
These are all excellent points. I think people often focus way too much on the purely monetary aspects when it comes to compensation, keeping people happy, and forget the managerial aspects and also how you can get much more creative about this. We're almost out of time, but let's take one more question maybe from Armon. I think this is probably for Yoko best. If done right, recurrent liquidity, i.e. secondaries, are seen by some as crucial element for retaining key talent. What relevance do secondaries have in Europe in the current macro, and do you see this change in the coming years similarly as in the US?
Yeah, so I think first of all, yes, I think definitely secondaries are key for the reason that it just makes equity very tangible. It's like immediately, okay, actually this is real. It transforms into actual money at the end of the day. So in that sense, it's really important. I think the other thought to that question is, I think hand in hand with the culture of giving equity in Europe versus in the US, it goes hand in hand with that maturity of the culture of giving equity. So secondaries follow, I think, that maturity, and specifically, so that's one trend, right? Like, what's the maturity of the ecosystem? That's one trend, and therefore I think it will increase with that trend in Europe, clearly. The second trend is just the macro environment right now, the economy. I think there, secondaries very typically happen when there is a fundraise, because that's where there is a lot of movement. There is new buyers who buy out shares, and so the reality, I think, in this macro is that just happens less. So there are just, in my experience, less secondaries happening, both in Europe but also in the US in the current macro, due to that reason of less fundraising.
Great. We are already a bit over time, so we should wrap it up. And maybe very last quick question for both of you. What's kind of the most important tip maybe from a compensation point of view for startup leaders that we have not yet talked about or not talked about in much detail? Final words of advice.
Yeah, well, for me, it's clarity and conviction. So, have conviction in your thesis, and have the clarity when you're explaining it to whoever you're explaining it to.
Great. Yoko?
For me, it would be keep it simple, but do it. Just do it. In the sense that, just one clear example, clear call to action would be around education. It's one of the biggest differences to other ecosystems outside Europe. So just, take 15 minutes, do a great package to explain equity to your employees and involve your founder. I saw one question here by Kerime, who should own the discussion. It can be anyone actually who owns it, typically from the people team in larger companies, or legal, but just having one owner and then involve senior stakeholders and founders. So yeah, sorry, stopping here. Keep it simple, but just doing it.
That's great advice once more. So thank you very much, Yoko and Vaso, for being here today. I think this was extremely insightful for everybody. And yes, we got a lot of great points today. Thank you, everybody, for attending. There will be a recording also if you want to listen to some points again. And you also can find us on LinkedIn. Happy to engage, of course. And yes, have a great rest of the day. Thank you.
Thank you so much.
Thanks all. Goodbye.